Hi, good morning, everyone. Hope everyone's doing good. It is the top of the hour here, 11:30. We have about 32 on. We're just going to give everyone about another minute. We should have about 43. So hang tight. We'll start in about 1 minute. Alan and I are the offensive and defensive coordinators today for the NFL. All right, perfect. Looks like everyone is on here. Thank you, everyone, for joining us for our second virtual Lunch and Learn. We spoke with everyone here over the last few weeks. It sounded like everyone was doing good, staying home and staying healthy. So it's very good to hear. And today we're going to have a lunch from home. So get comfy, relax. Make sure your volume is up on your computers, on your tablet or your cell phone. And this video and webinar will be recorded. So at the end of the webinar, it's going to be about 45 minutes. Later this afternoon, it will be emailed to everyone on the call as well. Some milestone news. My father just turned 80 just a few weeks ago on July 9th. This is my father, John, right here. This photo on the left was taken about 5 years ago. It's my younger brother, David, and myself here, and my middle brother, Aaron. So I grew up on a farm in Kenora, Saskatchewan. It's just north of Montana, a couple hours. And as you see, all this wood here, they split a lot of firewood for local farmers in the area. And one of the reasons I love math is because I got to put it to good use at an early age. Before my younger brother David and I could go out in the yard and play after school, we had to stack what's called 1 cord of wood. So 1 cord of wood, which is going to be over here, is 4 feet wide, 4 feet high, and 8 feet long. So in the back here, there's about 50 cords of wood, all split by my brother Aaron and my father John. So now that he's 80, he's feeling a little bit of aches and pains, but he says he loves getting up and going to work. So where they're at, they had 0 cases of COVID. Their nearest neighbor is about a mile away, so they haven't really seen anyone for the past 5 months. But they're doing well and staying healthy. My little one here, this is little Ariana. She's now 3 and 3 months. This photo was taken a few months back in the park, and she loves doing her ballet at home, and she loves her puzzles. We went over to Target and we got her 7 boxes of puzzles. We were hoping it was going to take a week to do, but she sat down yesterday and didn't say anything for 2 hours and literally put all 7 puzzles together. So it's quite amazing to see what kids can do. Everyone is healthy and happy as well. Today's agenda, we're going to have one more webinar video in October 29th. We're going to go over the 3rd quarter review, which is happening now between July and the end of September. And we're also going to have a guest speaker named Michelle Alba. She's going to be talking about fall prevention and how to keep safe in your home and minimize falls. Very important. Handouts. If you look to the right-hand side of your screen, there's going to be a handouts box. It'll have the PowerPoint, cost of long-term care, and as well as a long-term care conversation. Please feel free to download those. If anyone needs a copy, please call our office or email Michelle and she will get those over to you. I'm going to go over a high-level recap of the 2nd quarter, which just happened between April 1st and June 30th. We have a guest speaker who's going to educate us on long-term care. And at the end, in about 40 minutes, we're going to go over a Q&A. Please click on the chat box on the right-hand side. It should be near the bottom. There'll be a little arrow that says chat. Type in your questions in there, and we will answer those at the end of the webinar today. All right, second quarter, April 1st through June 30th. The second quarter, as we can see here in the middle of the screen, was night and day from the first quarter. On the darker green line right here, this is your US equities. The next green line here is your international over in Europe, and emerging market equities or stocks, down in Brazil, South America. All equities were positive for the second quarter. And over here we have US bonds, international bonds, and emerging market bonds. These were also positive. So very good signs over the last 3 months. On the right-hand side here, we have year to date. And as you can see, US stocks, they're still a little bit behind on year-to-date growth, which is not too bad. Emerging markets in Europe are still down almost double digits, and Europe is down double digits. The blue line here, which is our bonds that act as a ballast in our investments, they're holding very stable, which is very good. And I just want to point out a couple of things here. This right here on the blue line is the S&P 500. As I said on the slide before, it's still down about 3.1. S&P is made up of 500 companies, small, medium, and large cap from US and Canada. But what's been driving this growth has been tech and consumer discretionary, which consumer discretionary was up a lot, over 30% this last 3 months. What that is Amazon. Amazon's driving a lot of it. I don't know about you, but I've probably get a box or two every week. It arrives at my doorstep. So UPS, FedEx, the Postal Service, they're keeping very busy, very essential. And technology right here, which is still up over 15% year to date. I'm sorry, year to date as of June 30th. I mean, we're on a webinar today, a virtual webinar, but all of us are using our phones and our computers. So certain sectors, which I'm going to go over on the next couple slides, have been lagging, but technology has, a lot of the companies have doubled in stock prices, which is good to see. So right now we currently are in a recession, and as you can see here on the right-hand side, this started back in February, which is about 6 months ago. The GDP, or you want to think of it as a scorecard of the economy, when people are spending money, people are still spending money, just not in certain areas. So the GDP is down about 12.8. What this is comparable to would be back in the early 40s after the Second World War. This is where my parents, my dad was born in 1940, my mom was born in 1943. They were right in the cusp of the baby boomers, which a lot of us on this call are baby boomers. So between 1943 and 1964, a span of 21 years, there was 76 million baby boomers born. And just a fun little fact, there's 10,000 baby boomers turning 65 every day until about 2030. It's a large segment of the population in the US. How is the recovery going to look? It's going to look one of the, either as a V shape. Sorry, my mouse was lagging behind here. This was back in February, right around February 19th, and we kind of went off a cliff. It only took 18 trading days to drop down to negative 35. And depending on the recovery, it's going to depend on how quickly non-essential businesses get back out and doing business. So it could be a V shape, could be a U shape where it's dragging a little bit on the growth, or it could be a W where we get a second spike in COVID and things dip back down again. But one thing is certain, the economy will recover. It's just a matter of when. And right now we have 1 foot in the pandemic and 1 foot in the recovery. As I said on the 3 slides ago, technology has done really well, so it's really growing. A few areas that are lagging behind are hotel occupancy. Not a lot of people are going to stay at hotels. Over here in the purple is flights locally in the US. That's down as well. And then TSA reported, international travel is down about 79%, as well as going out for dinner. That's down about 65%. So certain areas are lagging, and it's going to be a while before those get back to normal. Some things that are up though are driving. People are getting out on the road, and as well as people buying and selling houses. Those are still up. That's a positive 15%. Just to go back, about 70 years to the previous bull and bear markets. As we can see here in the red, this is where we're currently at. This is the data. And we just finished a long 11-year bull run. I remember this very well. This is the subprime mortgages here and from 2007 to 2008. And then we had the dot-com crash here, Silicon Valley back in 2000 to 2002. But what the blue lines show us is the average bull market is going to go on about 6 years, whereas the average bear market is going to go on about a year and 2 months. Right now we're about 6 months in. We're right around the middle. We still have about 8 months to go according to the averages. So once we're out and we get back spending more money, it's going to help raise the economy again. Even though the economy has slowed down, moving forward, it's very important to stay disciplined and stay focused on your long-term goals. So we're not here to make you rich, we're here to keep you rich, making sure we're preserving that principle. And we're going to go through some major roadblocks, in the next coming months. Once we get this curve down, it's going to be a lot better and things open up again. But it's still a long journey ahead of us. And if anyone has any questions regarding their investments or any concerns, if we need to make an adjustment, please let us know. And I've just made a little arrow here, part of my artwork here. But when we look back in 2030, 2035, eventually we're going to put this in the rearview mirror. But right now we have plenty of work to do in front of us. And right now we're managing your investments, making sure that you have plenty of cash flow. That's very important to manage your money. That's why you have us at Pacific Excel. For a complete retirement plan, it's important to look at your insurance. And what I mean by that is, God forbid, if we had to go to a nursing home, assisted living, or need some home health care, number one, who's gonna take care of that? And number two, who's gonna pay for that? So today we're gonna get educated a little bit more from our guest speaker. He is originally from Iowa. He's been married to his wife, Karen, for about 33 years now. He has 2 daughters and 1 son, and he's been doing this for about 30 years. He really loves what he does. And I had the pleasure of meeting him a while back, so I thanked him for joining us. I'm going to go ahead and pass the microphone over to Alan Miller. So everyone, please welcome Alan Miller. And we're going to do a quick audio check here.
Thank you, Nathan. I'll wait to get your thumbs up on that.
You are
audio good?
Audio is good. Yeah, go ahead. Thank you.
Awesome. Hey, even though we got these cool headsets, air traffic control equipment here, sometimes you just got to make sure it's working before the plane takes off, I guess. So, Nathan,
Yes,
again, thanks for having me as a guest speaker here. As Nathan mentioned, I am passionate about long-term care. I grew up in Iowa, small town. My mom was one of 13 kids. A lot of my friends, cousins, had large families as well. And so I got to see long-term care up close because back in the day, long-term care was a matter of the community or the family taking care of it. I subsequently received a job offer to come out to Colorado. That is where I reside. As Nathan mentioned, I work for Lincoln. Think of me as a manufacturer's rep. Lincoln manufactures many retirement plan solutions. They have me in Colorado covering part of the Western region to support wealth management services like Nathan and Pacific Excel. And so I congratulate Nathan for bringing this topic up because it's an important topic. It's a way of completing a great financial plan to say, hey, I've got the assets, I've got the allocation in place, and I've got a steward, a trusted advisor in Nathan, but what if I have long-term care? And that's the one unknown that can throw off all of these, analysis and markets. And we'll touch on that a little bit. But going back to my personal story, now that I'm out in Colorado, my mother-in-law is starting to incur long-term care events, and my wife is originally from Illinois. And so what I'm seeing firsthand is that having the conversation with the family 5 years ago has really prepared my wife and her family for a long-term care event. And long-term care events aren't just sudden, they can be very gradual. So, part of what I've talked to Nathan about is, if there's one thing that you do today from this lunch and learn, is to start the conversation, have a family conversation, discuss with the family, with Nathan, what's the plan. There's more that goes into it, but that's where we want this to be a starting point. And I'm relaying a personal story of how it's helping. I know my in-laws walk through and deal with what do we want to do down the road if this continues or persists, or have it. It's beyond just the funding aspect of it. It's what's the impact to the family and the consequences. And so, Nathan, if you could go to the next slide. You start with realizing in that conversation, what's the risk? Well, longevity is a blessing. Longevity happens to be something we all want. The longer you live, the longer you will live. But the longer you do live, the more frailty jumps in or comes into play. That, not using a handrail, all of a sudden fall down a step, and I cannot perform the way I used to perform before an incident like this. Or it could be, some of the illnesses that we see, like dementia, that the longer you live, the more likely that event will happen. So that's a real risk. And I know Nathan and his team evaluate longevity, and that's probably a top of risk they try to work on. For a lot of people, they'll look at it and say, okay, that's great, but healthcare is what I'm concerned most with. I'll go back to that conversation of having, or that point of having a family conversation. Family individuals don't want to be a burden to their family. They want to be independent and on their own. And that's where, okay, I'm blessed to live longer, and I may now have more risk of health care because I do live longer. Well, what's that cost of care? What will it take to have care in my home? And that's typically what people would like to have, is to be in their home having care. And so we'll look at that cost here in a moment, but then what we're going to do is we're going to talk about the 4 myths that come with long-term care planning. Again, walk away today saying, let's have that family conversation. The person who maybe has an event of long-term care will get taken care of. It's more of, what about the surviving spouse? What about the family? Again, back to my personal story, we're in Colorado, they're in Illinois. It's not a matter of leaving work early. It's, how do we have someone come into the home? And that is the other risk, the real fundamental risk. And so, Nathan, if you could go to the next slide, there's a lot of ways of determining what the cost of care is. I would suggest, at minimum, if you want to research this on your own, you could look at longtermcare.gov. That's longtermcare, one word, .gov. And you could go in there and find out your specific zip code and put in an age that you might need long-term care. At Lincoln, we've been doing long-term care solutions for 32 years. Our average age of claim is age 83. So if I'm a 60-year-old, I could go to a cost of care calculator, or have Nathan run that up for me, and find out what it would cost for care. And the care typically we want people to look at is in-home care, adult daycare, assisted living facilities, not necessarily nursing home. You can see the fourth number down, nursing home today, or as of 2019, 155,000. Pretty daunting number, but that's not typically the anatomy of a long-term care claim. Nursing home is more at the end. It could be something sudden, but typically a nursing home or an in-home care event could be I fall, break my hip, I have, hip surgery, but the recovery doesn't go well. And we'll talk about what long-term care is, what's the definition, and how would you qualify or be spending your own money on. So you really want to focus in on the third bullet point. I'm sorry, on the second bullet point, home health aid, assisted living. You're looking at today somewhere around 50 to 75,000. So we could just say on average, maybe 60,000. So if I'm 60 years of age, the question really becomes, what will it cost me if I have a claim at age 83, which is the average Lincoln sees, or 80 or whatever number. And you can look at that and say, okay, it's going to cost me probably at a 3% inflation rate on healthcare, $120,000 a year. $120,000 a year for how many years? Forbes just had an article written last week. It shows the average claim is somewhere around 3.9 years. So you could look at this and say, what's the risk? The risk is if I have long-term care event, it will cost at age 83, perhaps $120,000 a year for 4 years. That's close to $500,000 of just long-term care. This isn't Medicare premiums and eyewear and things like that. This is just what we call unhealthy healthcare costs. Now, what's the risk? I mentioned longevity. The longer you live. Households who reach age 65, a husband, wife, 1 in 2 will have a long-term care event. 1 in 2 will have a long-term care event. The part of it is for how long, what age, don't know, but that's where good planning comes in. But that planning starts after your lunch and learn here today on what is my plan. And now you know that it happens more frequently, obviously, with the growth of the demographics of the baby boomers, and the fact that more families have dispersed and moved to different areas and maybe raising their own family. It becomes a question of, if I have health care, what's it going to look like and how do I pay for it? And that's where the cost of care is one of the risks to evaluate and to look at. And again, a lot of good software, a lot of good information out there. This serves more as a launch pad for understanding long-term care and what the risks are. Nathan, if you could go to the next slide. We now will talk about what is long-term care. And this helps set the stage for the 4 myths of long-term care. Long-term care, if you think for a moment, any day today, you got up and you did what? What were your activities? Activities of daily living. That's what we define, the IRS defines what a doctor will write as far as a plan of description on whether you can perform those activities of daily living. There's basically 6 of them. I got up. I transferred myself from the bed to the bathroom. I toileted. I maybe showered. I went downstairs. Well, I guess first I put my clothes on. So I got dressed and then I went downstairs. My wife has a preference for that, but I then now made breakfast. I now have 2 other activities, but you think of what might be my activities of daily living. When I can't perform those on a longer term basis, definition is over 100 days, then
they get an appointment?
Then you will have a care plan written for you where now you're eligible for long-term care. So basically, know that what long-term care is custodial. how can I have someone come in and help me transfer from the bed to the bathroom, to help me with toileting, to get dressed, eating, and it goes well beyond that, but it's a matter of, can I perform 2 of those 6 activities of daily living? Once you cannot on a long-term care basis, then you are now spending your own money through your plan of self-funding, or you're tapping into a long-term care solution, what we call long-term care and care insurance, which we'll touch on in one of the slides in a few moments here. But that becomes kind of a basis, a little education of Nathan. I think we have that audio back.
Yes. Sorry about
Okay.
that.
Yes. Did I? Where did I leave off before we had the muting kind of finished up on the definition of what long-term care is? I think that came through. If not, if I wasn't clear, perhaps a question might come across in the chat room.
Could you go over that again? Because I hit the mute button and apologize for that. Joe, do you want me to go back to here? Could you repeat that?
Yeah, I just I was talking about long-term care. It's just important to know, and I always like to say, think about when you got up this morning. What were your activities of daily living? Right, you got out of bed, you transferred yourself, you went to the restroom, you got yourself ready, got dressed, went into the kitchen, ate. There's a couple other ones that are in there, such as consonants, but it's a matter of understanding that I cannot perform these activities of daily living, and I cannot perform those for more than 100 days. And your doctor is typically the one that is writing a plan of care saying, you fell down, you broke your hip, you're going to have hip surgery, you might not be able to perform for 6 months. That would be a definition of long-term care, where either you're paying for that yourself out of your self-funding, or you would now tap into a long-term care solution like long-term care insurance to have it paid for your custodial care. And it's important to understand that custodial care because it helps frame or walk through the 4 myths, which we can go into with the start of the next second slide after this one. Right? So 4 myths, what most people think. Myth number 1, it won't happen to me. I'm not that 1 and 2. If I'm that 1 and 2, it's certainly not me. I'm not the person that will need it. Well, again, longevity produces longevity, and longevity eventually does make someone a little more frail. So we're a little bit out of control on this. A lot of times people response, and you can guess it's probably from the male. Well, if it happens to me, just do this, and that's not a real good plan. But there is the certain mentality that I'll just deal with it at the time it happens. But basically, I don't think it's going to happen to me. That's a very reactive plan. It's again a matter of reflecting on your own household, family, extended family, neighbors, their family, to know this is a real event and it's a real risk in retirement, because we walk through that cost of care, those numbers, that it's very real to have custodial care come in your home or nursing home care, that it can be very adverse to the spouse, surviving spouse, the family, etc. So this is not a good option really to think about, because it can happen. The statistics show it, and the demographics are supporting this. Is just continue to be an event for retirees as we get older and move on with our lives. Myth number 2 is Medicare and Medicaid. This is what will cover cost. For Medicare, you have to understand that's short term, and it's typically hospitalization, skilled nursing. This is not a custodial type of coverage that comes from the government. It's our health plan, good health plan in place. I have a client who's has a mother that continually has emergency visits. It doesn't qualify for long-term care. It does get covered by Medicare, but now is at the point where she cannot perform 2 of 6 activities of daily living. Therefore, the doctor has written a plan, and now an individual can come into the home so that the falls don't happen, and that would be covered under a long-term care insurance plan, not Medicare, or it would be coming out of savings, a self-funded plan, right? Medicaid is not a program for anyone who has substantial means. It is aid. It is designed by the government for means testing, that you will have it, but here's what your assets have to be. And some people look at this and say, well, gosh, I could spend down. The limits are very low. You have no control of what your health care quality is going to be, because you would be working with a Medicaid facility. So for most people who are of any substantial means, this becomes an option that really is not on the table. But again, it's myth number 2. Isn't that what Medicare and Medicaid will do for me? There are some sponsored plans and private health insurance that are out there. I like to say your plan right now is your own plan. By doing nothing, you have a plan, and that is you will pay for it out of savings, or you will, have some family member take care of you. But any plan, anything you get from employer or whatever, is beneficial to cover what some of those costs are and the way you would like to have a long-term care event handled if it happens in the future, because of the aspect of the reality of life and what retirement would be. But myth number 2, Medicare, Medicaid, even private insurance will cover these costs, is not really on the table for most of us because of the way Medicare is structured and our own financial means. So we'll move to Medicaid, myth number 3. I plan to self-fund, so I'm good. This goes back to what I was saying. By inactivity, a lot of people have a plan. The plan is, oh, I'll use my savings. Well, that could be your plan, and that could be a good plan. But there are, as you'll see in a few slides, a way to say, well, why would I want to pay for health care 20 years from today at a full cost of $1 when I could have done something in 2020 with maybe assets that aren't using a whole lot of money? I could have bought long-term care insurance, and because of the leverage that I get with the long-term care insurance, I'm only spending 10, 15 cents for long-term care in the future. So a lot of affluent people will look at this and say, well, I have the money, but why would I want to spend $1? Or if I have the money and it's a bear market and I may have to sell some capital because I'm not liquid enough to spend or pay for long-term care over an extended period of time at 120,000, I might sell capital. Well, if it's a down market, now maybe I'm spending $100 or $1.20 for long-term care, not just $1. Maybe I should have looked at something that gave me the right way of doing it. Long-term care, when benefits come out, are tax-free. So therefore, the aspect of doing something now as opposed to self-fund not only helps pay for something at a very discounted rate in the future, but it also gives a great comparison to what would I have to earn on other investments to get to that same tax-free type return. So you do have a plan in place, I would guess, and most of that would be it's self-funded. 78% of people surveyed say, I would like to have the conversation on long-term care. I think it's important, but only 13% of the population has long-term care insurance in place. Big disconnect from, boy, I think this is important, to actually doing it. And again, that's why I think the PDFs, this lunch and learn, are a great starting point, because it is a decision, needs to be thought out, and to say, how do I do it? How do I do it the right way? Is an important one to do. But just know you do have a plan in place, and it's called self-funding. And now we're going to examine, is there better ways to do it? But I'll finish first with the fourth myth, and that is my family will care for me. And that may be the case, but a lot of times families look at this and say, I don't want to be a burden. Or if this is going to be the plan, then ask the question, who's going to be the primary caregiver? My brother, a few weeks back, who just turned 70, called me up and said, hey, where do you think markets are going? Up, down, sideways? It's like, hey, I don't know. I'm in the business. I'm around a lot of smart people. But let me ask you something, because you've not had this conversation with your family. What's your plan? And Roger's response was, well, my wife, Cindy, will be the one that will care for me. I'm like, Raj, you really think Cindy's going to be able to transfer you to, change clothes, do some of the things that might be needed? Possibly, but what a burden that puts on her. Okay, well, his son, PJ, well, PJ's running a Subway franchise. Will he have the ability to leave work? Typically, 1 in 4 caregivers spend about 41 hours a week on caregiving. The burden again to the family is time, it's treasure, but there's a myth that that's what my family will do. And that's something, if it is the case, then more conversations are needed than less. And so when you look at the 4 myths, you can see a lot of the long-term care planning that, the risks that come with it, come with that family conversation. Let's take a look. What might it look like? How are we going to do it? And then it comes, I think, last and to the last point, how do I fund it? What do I want to fund it with? Which leads us to, Nathan, our last slide here. And that is, there are options for long-term care. We're not going to go into great depths of each one of these, but we call this the long-term care planning spectrum. We start on the far left. That's self-funding. That's what I mentioned. A lot of people have that plan. If you have care 15, 20 years from today, you're paying full dollar for it. What if I was to get to the far right and have care coverage that we call traditional? Traditional LTC insurance is the Genworth, the Mutual of Omaha, the CalPERS, the individual plans that you kind of pay as you go. Think of it almost like auto insurance. As long as you have an automobile, you are going to have coverage of that automobile. If you never get in a wreck, I don't get any of those premiums back. Homeowners insurance. Colorado, we get a lot of hailstorms. Our rates have gone up. That's one of the things that have happened in the traditional pay-as-you-go health type coverage is premiums are going up, and that's the structure of that. What other companies have done, like Lincoln, is we've said, well, let's give a little different approach. Let's have someone own it. And now I'm just going to the left, called life insurance / LTC combo, what we call asset-based coverage, where really what you're trying to do is buy, like traditional LTC, good long-term care coverage, good leverage, tax-free, but I'm buying it on a life insurance chassis. And the advantage of that is I own it. Premiums that I put in will never go up. Everything's guaranteed. If I need it, here's my long-term care benefits. Because it was built on a life insurance chassis, if I never use any of the long-term care, I die, it goes to my spouse. Or if I'm a surviving spouse, it goes to my kids. So I get my premiums back if I never use it, but I can get life insurance, I can get long-term care insurance with it. This is something that has been around, for example, like with Lincoln for 32 years, but has been taking on more popularity because of what's happened in the traditional side, and because more caregivers are involved in this family planning, this conversation. They're looking at this saying, well, great, I'd like to have that, and the plan would be for me more to be the purse, not the nurse, in a long-term care event. I like this combo approach, or what we might call hybrid. If you shift to the middle, you'll see life insurance that has what we call an accelerated benefit rider, meaning you're buying life insurance really for the death benefit. But if I want to accelerate the death benefit and use that to pay for long-term care, still get the tax-free advantages, I'll do that, right? And then to the left of that, right above self-funding, there's options for Nathan and his team to say, well, what if we just got an annuity that had a long-term care rider to it? Those options are available as well. So you can start with self-funding on the left, and you can dial it all the way up to traditional or anywhere in between on what fits you most. But your question is, what's my plan? What's it going to look like? Who's my primary caregiver? Now you're asking, how am I going to pay for it? And for a lot of people, it's self-funding. Some people will say, hey, I've got the traditional. That's great. Is it enough based on what cost of care might be at 83? And that's where we can work through and simplify what could be a better alternative for the family, the household, to pay for these long-term care expenses as they will continue to grow and continue to be a challenge for the financial plans that take into account different scenarios of return. But what scenario can you paint as far as health care? Like, how long might it last? But those are things we work with Nathan and his team to better hone in on, not over-insuring, but getting the right amount. And again, that goes to starting the conversation and what might be things that you are concerned about or concerned, and address it. And it is a process. It is a way of looking at it, even though once you get into the long-term care application, you'll find it's very streamlined, very easy to do with it, because it is more of a streamlined process of checking in for cognitive reasons and looking at the Medical Information Bureau, but it's not a long drawn out type of underwriting process. Each one of these solutions have different ways of doing it, but I'll not get into too much of that. Just know there are other options on the table for you to consider as we finish up our lunch and learn here, starting an education on what long-term care planning is and it's about, and dispel some of the myths that go with it, with the idea that this is time well invested by yourself to do something better for your family and your household, and particularly yourself and your retirement. So Nathan, I will stop there to see if you've got questions, or if there's questions that have come in that we might be able to address more specifically.
Thank you, Alan. Let me pop here to the next slide. Anyone who has questions here, that's going to be on the right-hand side of your screen, and there's going to be a question box.
And Nathan, I know you put out the PDFs there, the one PDF that hopefully everyone would look at. It's starting the long-term care conversation. It has a recap of those 4 myths and a few other details as well that could be something to reference and go back to as you're having those conversations as well.
Absolutely. So I'm just going to unmute the questions here. I think I got the hands. Just put in. So we'll pause here for 5 minutes and take questions. Just going to read this back. And Alan, this one is going to be for you. So on myth number 2, Medicare is going to cover a portion of up to 100 days. Is that 100 days per year or lifetime?
Well, again, first of all, Medicare is going to cover an event that you go into hospitalization, need skilled nursing. If you need custodial care in the home, it will not cover day one. Okay, so Medicare, understand that's health insurance, and it covers at events, say to a hospital. But if you need some care at home, then that will not be covered. To the Medicare question, that would be more of do you start over a 100-day period for what Medicare will cover, right? So distinguishing the two, Medicare says you have an event, you go in the hospital, we can cover you up to 100 days. You could go into the hospital, be out in 10 days, 20 days later, something else happens, you're back in, you're back under Medicare. If you went into the hospital, went home, and could not perform 2 of 6 activities of daily living, Medicare is not going to cover anything. You would be on your own, or you would call up Lincoln, for example, and say, I now need long-term care to pay for that custodial activity. So that 100 days, it's a great question, because you're saying, well, wait a minute, they're covering you for 100. They're going to cover for what your emergency room visit is, your hospital event. It's like your current healthcare coverage. But once that's done, it's done, but they're only covering you for a certain amount of time. And don't confuse necessarily getting my health care paid for from getting my custodial care, which, again, is a doctor saying you went into the hospital, you were in there for 5 days, now you are out, but you're not going to be able to perform these 2 of 6 activities of daily living. You now could call Nathan, and Nathan would call Lincoln, and Lincoln would say, no elimination period. We are going to start paying that day what you need to have someone to come in to your home and perform custodial type activities. But it's not healthcare that is involved there. It's health providing of health needs that come with an event that would be from a say hospitalization, or what do you mean that? You could fall down the steps and never, go into the hospital and still need a custodial type event. Hopefully that answered the question.
And for all the questions, we got a lot here. I'm going to answer all these. And Alan, and just to answer the question too, and that is limited too. So that lifetime, that is limited for Medicare.
I believe so. Yes. Yeah. I would double check on that one.
Let's see here. I'm going to go on. Next question here. Here's a good question. Are there any recommended life insurance companies that offer long-term care insurance? There's a few, yeah.
Yes. Yeah, I'll start with, you've got the traditional, correct? Some good companies there. You may see some press on some that aren't so good. They've got to raise their premiums. Genworth, but I think a Mutual Omaha. And again, Nathan, you and your wealth management team have a great access to a lot of different companies. What we've seen in our area, which is the linked benefits, the hybrid, the Lincoln Money Guard, we've been around 32 years, but we've seen new companies come into the market. Now, they've not had the claims paying ability that we have from our claims paying history that we have. So that leaves a little question to it, but we're seeing more and more companies come into our type of space versus the traditional. Traditional, you're maybe seeing a little more of a decline in that area, a little more of a challenge of maintaining that, but we're seeing a little more expansion of the life insurance as the chassis, and then giving the long-term care riders. So I'll leave that to you and the team that you work with there over at Advisors Excel to better answer what you feel. But I can speak to Lincoln with 115-year history, 32 years. We have a strong commitment and strong market share presence to continue to be available in this type of area for the retiree.
Exactly. Yeah, Lincoln's good, and there's also other companies as well, very strong. That's good.
Yes.
Next question here. So we'll answer questions for another 5 minutes here. This is a good question. Is there an age limit for long-term care plans? I have a grandmother who's going to be 102 in August and is in need of a long-term care plan. Is it too late for that?
Yeah. First of all, congratulations on the long life there. The issue for us, a policy issue, is 30 to 80 years of age. So you're typically looking at somewhere around 80, but again, I would defer to Nathan and his team to search, is there someone that could issue? For us specifically, we have a max issue age of age 80. And a lot of times the question comes up, well, what's the premium? What can I do? You can do it lump sum. You can do a pay as you go or have it funded by a certain age. We're typically having or requiring that policies get paid up by age 70. So I'll answer the question. Right now, the marketplace is really more for 70 and younger. And in part, that's because of the current COVID-19 health pandemic that we're dealing with, that a lot of policies companies have shut down issuing beyond age 70. But absence of this COVID-19 world that we have, a lot of times max issue ages wouldn't go beyond age 80. Not to say that there isn't one or two that are out there. I wouldn't have a knowledge of that right now, but that could be answered in a follow-up question from yourself, Nathan.
Yeah, and there's ways to look at that. There's ways to help fund it. And so I'll speak on that too directly. Our client who asked the question, so very good question. Actually, I will answer 3 more and I'll answer every other one on a personal email. This one's for Alan too. So with everything going on right now, how are interviews and testing being done with Lincoln?
Another excellent question. We've always been simplified underwriting, and as of last year, worked on more e-delivery, e-capabilities, where effectively, Nathan, you would not have to leave the office, your client would not have to leave the home, and everything could be done electronically. The underwriting involves getting some information on an application, maybe a little pre-screening of health questions. That's always nice to do. But then once that's sent over to us electronically, as I mentioned earlier, we just simply pull a medical information bureau report, a prescription report, and then we set up a phone interview. From that, we make an underwriting decision. So again, e-capabilities from A to Z, but effectively no one has to leave the home. And that's just part of the evolution that's happened with the linked benefit type products. Other products may still have maybe the visit that might be needed or fluids be drawn, etc. But in the long-term care area, a lot of this has gone to simplified underwriting, and with e-capabilities, virtually have no reason to leave one's home to have an application and an underwriting decision brought in. And I might touch on that in just a moment. You know, the underwriting, again, is simplified. And people ask the question, well, when should I buy it? Well, the easy answer is when you're healthy. And so the younger you are, the more likely that there hasn't been something that's creeped into your health that might cause, you know, a decline. It's not tough to get underwritten, to be accepted, but it is a club that basically we're saying if you don't use it, we pay out a death benefit. If you do use it, here's leverage tax-free benefits. It's 100% usage. So we are a little bit careful on the screening of people that come into the MoneyGuard program for the sake of all of the policyholders, as well as for Lincoln and quite frankly our profitability as well.
And I'll follow up. We'll take 3 more here, and then the rest of I'll answer. Alan, is there any cost if someone on the call wants to apply for this to go to see if they can get qualified?
There's no cost. No. You submit an application. We underwrite it. You get a yes, no. If it's a yes, you're going to know already through working with Nathan the illustration of if I want $500,000 of long-term care benefits, if I happen to go on claim at age 83, it cost me $6,000 a year over 10 years, $60,000. If I don't use it, I die, the 60,000 comes back, but there is no cost to do it. The only cost is the premiums that are guaranteed never to go up that go into the program and create the benefit that you would illustrate in the individualized in the illustration, but no cost to go through the program to see if you're qualified or can be accepted into the plan.
Good to know. Thank you. I'll answer this next one, then I'll pass you two more. So clients start with long-term care, whole life policy about 15 years ago. They're now 75. What are the possibilities of having enough funds to cover, for any years after age 83? So we would sit down and look at that, and we'll make a personal call so we can answer that question, just to look at it. So I know who wrote the question here, so I'll answer. Let's see here. This is a good question. So my father is nearly 100. What method exists to calculate life expectancy with family history or genetic evaluation aside from leading a healthy lifestyle?
Yeah, great question. That is part of it. What is in your genes, right? So looking at that, maybe I might be more at risk. I don't know specifically of something that can determine, do I have more life expectancy, say, than my spouse? I can research that a little bit more and get back to you, Nathan, on it. Right now, it's intuition on different households and what maybe happened with this side versus that side, or in my own history for it. But we are living better, we're eating better, exercising more, and that's just part of what we see statistically. Is life expectancy is forecasted to grow by 9 years looking out. So that's just a fact we can look at, that actuarially what we get told. But at a predictive process, I'd have to check on that, because that is very interesting to see if there's some way to take someone's genealogy and project what might be the likelihood there.
That's a very good question. All right, we'll take one more. We're just at the top of the hour. And the question is, this will be for Alan. Do you have a professional determine if you're unable to perform 2 of the 6 ADLs, activities of daily living, for the deductible period before you go to claim? So who gives them the green light to do the claim?
Yeah, excellent question. And I'll speak specifically about Lincoln, because other companies adjudicate their claims different than us. We have our own claim service, and so we make it simple. If your doctor writes up a plan of care and says you cannot perform 2 of 6, we accept that. So the specific answer to the question from a Lincoln standpoint is your doctor, your own family physician, is the one that writes up the plan of care. And with a Lincoln policy, there is a 0-day elimination. So I may fall, I'm going into hip surgery. The doctor may say, hey, when you're out of the hospital, you're not going to be able to perform 2 of 6 of these activities. We will start paying claim 1 when you get back home and have the need for custodial care. So specifically to us, it is a doctor writes up that plan of care. Your doctor does, not outsourced, not some other doctor that works for the insurance company. And that's a great question, because it helps decipher, how do I know what my claim is going to look like if I have an event? And that is one way we're able to answer it in solid terms. It's your doctor that's writing it. It's a 0-day elimination. And here's our 32 years of doing this to back up what we've been doing.
And knowing it comes out of the insurance company's pocket pretty much day one is a big relief as well. That's good. And Alan, there's actually one more. This is a really good question. And right before I know you got to get going here, if somebody has pre-existing conditions, how does that work on any approval type for long-term care, or does it impact eligibility?
Yeah, we have pre-submission underwriting tools that we give to Nathan, his team, that they can look at it and say, do you have any of these? And it's basically yes and no answers, right? Either you do or you don't. Have you had this kind of condition? Now, you might have had a condition and it's 5 years ago, and a doctor's report will validate that it's no longer an issue. Those are things we can talk through on the front end to say, are you eligible? Is it worth the time to go through and submit an application? It's called a pre-submission guidelines that we can look at to say, okay, specific to your individual health, confidentially, we can take that. Nathan can bring it to me. I could run it to our underwriter, and they're going to say, based on the fact that these 3 medicines are associated with this event, we would not have the ability to underwrite that person. We do that all the time, and that again helps to understand what's the the experience going to be like if I go through this. And it's a good practice to do, and I know Nathan and his team have done it as well. But it is good to know, based on this simple, what we call part 1 application, that just basically asks some health questions. Have you had this? I'll give you a quick one. Do you have a handicap parking permit? That's an automatic decline. Even though someone maybe is fully functional, they have the parking handicap sticker, they just forgot to put expire it. But that's simplified underwriting. We decline them with the idea that come back to us in 6 months and we'll look at it. But it's simple. It's kind of that type of process to look at and not get too in depth, but just ask certain quick health questions that allow us to get a pre-gauge of the overall health of the individual.
Very good. And the rest of these questions here I will answer as well. So I wanted to thank everyone for joining on this. Alan, thank you so much for giving us your time today and educating us. We really appreciate that. And everyone else on the call as well, we'll follow up with a personal email and personal phone call over the next week or 2. So I appreciate everyone for joining us, and thank you so much. We look forward to talking to everyone soon. So appreciate it. Have a wonderful day.
Thank you, Nathan.
Thank you, Alan.